Okay, so we're going to look now at the relationship between returns on asset classes. And the first thing we want to do really is to define the required return that an individual would have on a particular investment, and that's equal to the required risk-free real return plus the individual's expectations for future inflation over the term of the investment, plus some kind of appropriate risk premium to represent the risks and the uncertainties involved here. So by defining the required return like this, we're effectively assuming that most investors want to maintain the value of their investment in real terms. That's why we use the risk-free real return, and then receive appropriate compensation for the risks faced over and above inflation, or the expectation of inflation. And obviously different investments will have different risks attached to them, and therefore will have different risk premiums. So in this case, how might an investor determine an appropriate required risk-free real return? Well, what really is the closest thing to a risk-free real return that we can get in the market? It's probably the real yield on an index-linked government bond of similar term to the investment that we are considering. That's the closest thing to a risk-free real return over the same term. So we would use that really as a required risk-free return. And then the risk premium would reflect both the characteristics of the individual asset itself, but also of the investor's preferences, which are driven largely by their liabilities. So by that we mean that an investor with real liabilities might consider that a fixed interest government bond has a higher risk premium attached to it than a real asset like an equity, because there's a mismatch between the asset proceeds from the fixed interest bond and the liability proceeds. So it wouldn't necessarily be true to say that for a particular investor that the risk premium would be higher on fixed interest bonds than on index linked bonds. It would depend to some extent on the liabilities that were faced. Similarly, we can define the expected return that an individual investment will provide, and that's the current initial income yield. So that's the level of income divided by the current price, plus the expected capital growth. So it's the return that we can expect given the current price that we pay to buy the asset, and the expected income whilst the asset is held, and if relevant, obviously the expected sale price as well. Then if an asset is fairly priced, the required return and the expected return will be equal, and if the expected return exceeds the required return, then the asset can be considered to be cheap, and the investor might consider it good value to buy. So I suppose the key next step really then is how to estimate an appropriate risk premium, and the first thing really is that this is not as easy as you might think. Historically, when investors have purchased risky assets, the actual return that they've achieved will not be what they were expecting at the date of purchase. And the reason for that is that otherwise they wouldn't be a risky asset. If the returns had been what they were expecting, then the asset would not be risky at all. So what does that mean in terms of estimating the risk premium? It means that it's not really appropriate to compare actual returns on risky assets and risk-free assets and use the difference between them to estimate the risk premium, because that's not the risk premium that investors would require. It's the risk premium that's actually been achieved. So in this case then we can define the expected return on an asset class as the initial income yield plus the expected growth in the income, so the change in the level of income over time, and then plus the impact of a change in the yield. So for example, the price of an equity is given by the dividend divided by the dividend yield. But capital growth can come in the form of either the dividends growing, so the dividends increase over time, and therefore the present value of the dividends and the price of the equity will increase over time, or because of a change in the dividend yield. If the dividend yield falls, then the price of an equity will rise. Okay, so if we think about how this works for other kinds of assets, for a fixed interest bond, there is no income growth. The income is by definition fixed. So the initial income yield and the change in the capital value of the bond combine to give the fixed nominal return that's achieved, and by definition that fixed nominal return is equal to the gross redemption yield at the date of purchase. However, for a fixed interest bond, when inflation is higher than was expected during the term of the bond, then the real return will be lower than was expected. The nominal return will be equal to the gross redemption yield, but the real return will be lower. Similarly, in periods when yields are rising, then returns on fixed interest bonds will be lower than were expected at the date of purchase if the bond is sold prior to maturity, because if yields are rising, then prices are falling, and therefore the impact of the change in the yield is such that you are selling the bond for a higher yield and therefore a lower price than you were expecting when you purchased it. Similarly, if we look at index-linked bonds, then the real return rather than the nominal return is known at outset if we hold the bond to maturity. And as we've already seen, this real yield is often taken as a benchmark risk-free real yield for analysing our expected returns on equities. If we look at the returns on cash, then the return on cash can be expected to exceed price inflation in the long term, except perhaps in periods when inflation is rising very rapidly and therefore is underestimated by investors. However, from time to time, governments may keep short-term interest rates artificially high or artificially low to influence the way that the economy behaves. At the moment, we've got very low short-term interest rates in most Western economies to try and encourage the economies to grow after the credit crunch in 2008 and 2009. But at other times when economies have become in danger of overheating and inflation has risen quite high, then you'll tend to find that short-term interest rates are increased significantly over and above inflation to try and calm down the economy. If we look at this from the point of view of equities, then over the long term, the growth of equity dividends can broadly be expected to move in line with the growth in the GDP, the economic growth. As the economy grows, corporate profitability grows, and therefore dividends will grow as well. So in that sense, the real return on equities can be expected to be consistent with real economic growth plus the dividend yield itself, the income yield, the ratio of the current level of dividend income to price. And historical data suggests that this is a reasonable model for the long-term return on equities, but in the short term there will be considerable fluctuations around this. Obviously, the equity market does fluctuate very much on a daily basis, and in the short term, the return that an individual investor can achieve will depend very much on exactly when they buy and sell the equities that they hold. Well, finally, then let's just look at the growth in average earnings over time. This is particularly important for for institutions that might have liabilities that are earnings related. And two examples of these institutions, well, one would certainly be a defined benefit pension scheme where the benefits are frequently linked either to final salary or to career average salary. So in that case, the liabilities of the pension scheme are influenced by the change in average earnings over time. Similarly, if you're a non-life insurer selling income protection type products where the benefit provided will replace income lost when the policyholder is ill and unable to work, then typically you would structure the contract in such a way that the benefit increased probably in line with average earnings, not necessarily in line with the policyholder's individual earnings. That wouldn't be possible, but to increase it in line with average earnings so that the purchasing power of the policyholder was maintained over the time that they were unable to work. Similarly to the growth in equity dividends, it's reasonable to assume that in the long term average earnings will increase broadly in line with GDP growth, and the reason for that really is that as the economy grows, as GDP or national income grows, that's shared between the various factors that have contributed to that growth, in particular land, labour and capital. And assuming that the share of the GDP growth between these factors remains reasonably constant, then the labour component, the salary growth would be expected to grow broadly in line with GDP. Similarly, as we had previously, the argument is that the growth of the capital providers, the shareholders, if you like, their income should grow roughly in line with GDP as well, and that's the rationale for saying that dividends would also grow roughly in line with GDP. That assumes that the share of the total economy between land, labour and capital remains roughly constant over time, and broadly speaking it does, although there's a slight trend in recent years for labour rises to be squeezed a little bit and for capital providers to gain more of a share of the economic growth. So if that continues, then it wouldn't necessarily be true to say that both average earnings and dividend growth would be in line with GDP. If more of that GDP growth was going to capital providers and less to labour providers, then there might come a time where dividends grow faster than GDP and average earnings grow slightly slower than GDP. But I think we'll stop there for now.